Okay, everyone, welcome to our discussion today, Healthcare M&A for 2024, what the future might hold. I am Ari Markenson. I am a partner in the healthcare and corporate groups here at Venable in New York. Excuse me. And I am joined by Vasanta Pundarika from Matrix Capital Markets. Vasanta, why don't you introduce yourself?
Yeah, first of all, thank you, Ari, and thank you, Venable, for inviting me to this webinar. But I'm Vasanta Pundarika. I am head of healthcare investment banking at Matrix Capital Markets Group, and generally we cover healthcare services M&A just broadly across all the different subsectors within healthcare services. And I've been a healthcare investment banker for almost 2 decades now, and excited to be here and talk about 2024. It's shaping up to be an interesting year.
Great, thank you. Okay, so a little postmortem. 2023 was, I think most folks would agree, was a washout. Deal volumes were down in practically anything you take a look at by definitely over 75%. Why? What happened and why? Let's talk a little bit about that, Santa.
So I think it wasn't one thing. I think it's a series of things. And first of all, a series of economic events that caused interest rates to go up, and that started pushing valuation and started getting people a lot more risk averse. And so there started to be a few different things happening because of that. One is a disconnect between buyers and sellers on where valuation should be and where price should be, but also buyers trying to be a little bit more risk averse, trying to look at every single transaction a little bit more closely. Transactions started taking longer, which had a lot of transactions fall apart as a result of that. And so I think that was one of the guiding things that worked, that made the whole year slow for a lot of people, throughout M&A. But specifically, I think in healthcare M&A, there's also a lot of healthcare challenges that happened over the past year, right? That were building over the prior few years from the pandemic. Staffing is the thing we've been talking about in healthcare, all year. But all the staffing challenges, it forced a lot of companies to really look at their financials. Do we really want to go to market right now, or do we want to wait? And so a lot of people were looking at their own companies and deciding to wait to put them out into the market. And then there were other companies that wanted to wait out the market, upheaval and say, okay, I'm going to take my company out to market when some of this has simmered down and it's a little bit smoother. So I think it was both of those things, but spurred on by a series of economic events and healthcare challenges that kind of infiltrated all of our M&A activity. We love doing transactions, right? That's why we're all in this space. That's why the lawyers, accountants, and bankers are all in this space, as well as all of the investors. And so it's not something that just happens on a dime. There's a lot of different factors that contributed to 2023 being a little bit slower, I think.
Yeah, no, and I think I've seen all those same things, obviously, and I appreciate that. I mean, one of the interesting things that you raised, though, that staffing, and there's coupled, when you think about all those different issues, coupled with the mismatch that we'll definitely get to later, but in purchase price expectations and other issues, you had a lot of pent-up demand in healthcare from coming out of the pandemic. And it's very interesting. You had a lot of folks, sellers, speaking to buyers saying, we're going to have all this growth. Just look at what I've got sitting on the sidelines,
Yeah.
waiting. But then you have buyers saying, that's real wonderful, but where are you getting 20 new dentists or 20 doctors from, or to meet that demand, right? I mean, right now you're scheduling annual visits in primary care or in primary dentistry, right, 7 months out for your patients, for your existing patients, right? Like,
Yeah.
Now granted, you would think that will smooth out, in the sense that everybody who missed their annual stuff or slowed up on that kind of stuff will eventually get caught up, but that hasn't happened yet, right? And so I think that's actually a very interesting point above and beyond the other basic things about what's going on in the economy and what's going on in deal making, right? So
And it's not just the annual visits, right? It's also new things. I keep hearing from all my friends, like in normal everyday life, I haven't been able to get a doctor's appointment. I hear that constantly over and over again from friends. I hear from clients, hey, we've got wait lists out, 7 months. That doesn't make me feel good as a doctor because I can't actually see my patient that needs to see me for 7 months, but there's only so many days in the week and only so many hours. And I think with the staffing challenge, it's interesting because it started off as a physician challenge with physician burnout and everything happening at the early part of the pandemic too. And it kind of moved to mid-levels, nursing staff, and then now it's everybody within our whole healthcare ecosystem, right? We have challenges across the whole healthcare ecosystem with staffing. But it is interesting what you say is that, when you're waiting for it to smooth out, when is that going to happen? We've now been watching this for a long time. And it does seem like we need to start coming up with other solutions for healthcare because the staffing challenges aren't really going to go away. So we need to, gravitate towards types of healthcare providers and, partner with healthcare providers that can alleviate some of those staffing challenges. And I mean,
Yes.
we could talk about that all day. So
Right. I mean, and again, just to add to that, right? I found it very interesting. And I'll focus on primary care again. Primary care practitioners basically who you say, well, isn't COVID kind of over for you? And they go, are you kidding? Like the amount of incoming encounters I have of folks who want to get tested, think they have COVID, actually have COVID, need Paxlovid, all those things that's added 10, 15% encounters to my practice, right? That weren't there before. So it's one thing to say the pandemic is done, but COVID's still here, right? And folks who think they have COVID, right, who have flu or a regular cold or something else is becoming an issue, right?
Yeah.
And
if you look at, sorry, continue.
No, go ahead.
Well, if you look at urgent care centers, it was COVID, and are you getting this bump because of COVID, or is it RSV? Are you getting this bump because of RSV? Well, it seems like there's going to be something like that every year, and so I think it's not fair to negatively adjust for some of these things because they're sticking. We are continuing to have these kinds of patterns where people are sick and are having to go to see their primary care physician who's not available, so they're going to see their urgent care provider, and that seems to be a continuous cycle that's going. And I think early parts of last year, people didn't think it was going to stick, and now I've been hearing more and more from people that maybe this is here to stay.
Yeah, and a great segue to our next just piece of the discussion, and we're going to engage in magical thinking and totally ignore the fact that 2023 ever happened, and now talk about what's next for all of us. I read this headline in The Economist the other day, which I thought was interesting. It was how will America's economy fare in 2024? Don't ask a forecaster. The consensus is that there is no consensus. And it's very interesting because if you look broadly at economic journalism and financial journalism just about the economy, right, in the US and what they expect for 24, there's a lot of people saying lots of different things. But as you can imagine, a lot of hope that the naysayers are wrong, right? I mean, we have that every year anyway, but certainly hope that the naysayers are wrong. However, putting the uncertainty of what folks are predicting aside, right? Everyone I've talked to, and you and I talked about this a little bit the other day too, is saying that something has to give in the markets. Something has to give in the middle market, particularly in M&A, that's going to move things along. So with that said, what do you think?
So every week I get an email from at least one PE firm saying we just raised an X $100 million fund in fund insert number here. And I get the email every single week. I'm sure you do as well. So there are these private equity funds that are sitting on so much cash that they have raised from their investors, and they need to actually put that money to work. So last year they may not have put that money to work. A lot of private equity funds that I've talked to in recent weeks have said, we didn't do any platform deals last year, or we did a couple in the first quarter. Mostly what we did were add-ons. But that money is there. Investors have given it to them, and they're sitting on that money, and they need to be investing it. So how are they going to invest it? Well, a lot of last year, people were sitting on the sidelines and waiting for, this like game of like, who's going to blink first? Are you going to bring down your valuation, or am I going to bring up my valuation? But are we going to do this deal, or is one of us going to blink? And nobody was blinking, right? Everyone was just sitting and staring and continuing that that game that you play when you're little, right? Where you're staring contest or whatever it was called. But at some point, someone needs to blink, right? And I think it's with healthcare, there are so many investors that are generalists trying to be in healthcare, but there are also so many investors and so many strategic businesses that are in healthcare every single day that understand healthcare. They understand the challenges, they understand the regulatory challenges, they understand reimbursement, they understand staffing and what it's doing to healthcare. And I think those investors, they're still in healthcare, they're still committed to this space and are more and more excited about it because they are not nervous to jump into the fray. They're already in there. And so I think when those investors start doing some of these platform transactions, I think they are going to have to be first because I think they're going to need to lead the way. When they start doing more of these platform transactions, then everyone else will get a little bit more settled and calm about getting into healthcare with the platform type of transaction. But we do, I mean, it's everyone asks, like, what is your crystal ball? What's going to happen in 2024? And I feel cautiously optimistic about 2024 because there is going to have to come a point. We've had a whole year plus of time where everyone's been sitting on the sidelines, but there is going to have to come a point where people start blinking and people actually start trying to do some of these transactions. And there's a lot of new things happening in healthcare. There's so much innovation. There's so many exciting things happening. So there's a lot of opportunity for people to get into the fray, or that phrase that I used earlier, but to jump into the fray and to kind of go in a direction they haven't gone in before, maybe.
Yeah, he makes great, wonderful points. I mean, I talking to somebody the other day who said to me that we have got our largest fund ever, and we've only deployed like a twelfth of it.
Yeah,
And it's not a massive fund, but even so, that it was just like we've used nothing, kind of a thing. Um, and I've also heard from folks that who are actively trying to fundraise that they're getting a lot more scrutiny from their LPs, their traditional LPs, basically saying, where's your pipeline of what you're going to do with my money? Because everyone we've got money into right now is not using our money.
mm-hmm.
And we need to have our money used, right? Like that's the whole purpose of the structure, right?
Yeah,
And so, if you're going to tell me to give you 100 million for your new fund, but yet your fund's not going to do a deal in 2024, well, that's not what I want to see.
yeah,
Um, and so that I thought that dynamic, I heard that a little bit in the last few weeks from folks, particularly post JP Morgan, who were saying to me that when they got an opportunity to talk to some LPs out there, they were getting a lot of kind of arm twisting of, you want my money, you need to show me what you're going to do with it. Like
mm-hmm.
and I also have heard a little bit about that just LPs basically saying to funds that they're in right now that, look, we understood that you had to hang on to a particular portfolio company for a little bit of time after COVID. There was some tweaks and twists and turns and other things with that investment, so it was worth waiting another year or two to get out of it. But like, when you close out this fund, like, we can't let you just sit on this stuff for years upon years upon years. The idea was 3 to 5 year exits on some of these portfolio companies, and you're at 8, 9 years on some of these businesses. Like, we can't do that. So, you would think that those pressures will push deal making in 2024, right? You'd hope.
Right, right.
As beyond the other things that are going on, so
I like to
okay.
think about, when you talk to the accounting firms, the first thing that we do when we start a deal process is, bring the accounting firm in to start a QB process. And So if you talk to the accounting firms and say, how busy are you, kind of gives you a gauge of, what's going to be out in the market several months into the future. But a lot of accounting firms in the last couple of quarters of 2023 were really busy. But a lot, if you talk to them, a lot of those deals that they got ready are actually not in the market yet. So
Yeah.
there have been a lot of people that have been prepping to go out to market, getting those early things done, getting their financials in order, getting their documents in order, but they haven't actually gone out to market yet. So I think that should be exciting to some of these LPs, that there are going to be more companies out on the market at some point in the very near future, because these companies are getting ready to do that.
Yeah, one of the things that I think is interesting about that issue is and I wonder your perspective on this, which is because it seems like, and we're certainly going to get into this a little bit more in a little bit, but because it seems like buyers are poking harder at potential investments, I have seen on the sell side, right, a lot of I'm losing my words for it. Just a lot of sort of careful, sort of careful attention to when are we going to market and how, because we want to be as shiny as we can be, right? We're so it different from if you flip back. I'll go back even 8 years, right, where you threw anything at the wall and everybody was jumping at it, right? And anything in healthcare, it didn't matter if it had horrible hair on it. People were willing to pay for it and clean it up and deal with it and figure it out. And it's definitely, and I wonder if you agree with what I'm about to say, I don't think that that's the environment we're in now at all.
No, I don't think so. I think even a couple of years ago, if we go back to 2021, people, you don't have to go back 8 years, you can go back a couple of years. People were just getting transactions done as quickly as possible. Now I think when there's some hair on something, if it's something that's really interesting to the buyer, they will try to figure out how to work around the risk to figure out how to get it done. But if it's something that they were going to stretch to do in the first place, they're going to walk away before they try to get into that transaction. So I do think there's, and we can talk about this in a little bit, but I do think there's a lot of, I do think it's a really good idea, not to be a commercial for advisors and bankers or anything, but I do think it's a really good idea to get your books in order, to get all of your ducks in a row. You cannot time the market, right? The market does what the market does. And sometimes you can say, like, I'm trying to go out now, but then something else happens in the market that you weren't expecting. But what you can do is make your company be as polished and as organized and look as clean as possible. And have everything, sorted ahead of time before you go out to market, so that there are less of those things that jump out during the transaction process. There's going to be something, because the whole point, like the whole reason that, due diligence advisors are hired by buyers is to go find these things that are in the company. And so there's going to be something that they find, but the less things that they find, less surprises there are during the transaction, the more the company looks like what you said it was. I think the smoother a transaction process could be, which is, I completely agree with you, Ari. It's very different than 8 years ago or 2 or 3 years ago. We're in a little bit of a different world. And I think it makes the job of healthcare counsel so important as well, because I think when regulatory issues come up during a transaction process, you need to have healthcare counsel that's there, that understands all the regulations, that can really say, like, yes to this, no to this is not an issue, this is not a risk. So it makes all of those advisors more important as part of the transaction process. And I've seen clients who were resistant to hiring all the advisors that we were recommending. I've seen clients kind of say, oh, I understand why you said we needed XYZ, because it is more important. It is more complicated to do a transaction right now. And I mean, we have, we always talk about this, right? We have a whole set of people whose sole job it is to do transactions. So they're going to figure out and find out a way to do those transactions. So at some point in 2024, that will also start to push is going to come to shove at some point.
So we've pretty much talked a bunch about this just now anyway, but I'm still going to raise it and see if there's more things that we think we haven't really addressed, which is okay, so we're starting out 2024. We
Mm-hmm.
both spend a lot of time talking to a lot of different market participants about what they think about what's going on. You and I were talking the other day. Neither one of us actually went out to San Francisco for JP Morgan, but we have talked to a gazillion people who've been there, right?
Yep.
And so anything, particularly notable that you've been hearing from folks' attitudes, intentions, those kinds of things with respect to how they're looking at this year?
So, typically, whether you go to JP Morgan or not, it's the first full week of January, and typically some big transactions get announced during that week and big fundraises. There wasn't a lot of that this year, which was kind of interesting. Even, General Catalyst, they've stepped into health systems now, but they didn't even announce their transaction until it felt like after JP Morgan, right? But I think the general sense I've gotten from all the conversations and including conversations with you, Ari, is and I said it before, but cautious optimism going into 2024, where we didn't start off 2024 straight out of the gates with this big bang, like this is going to be a new year, but we are starting off 2024 where everyone's cautiously kind of saying, I'm excited about something that's going to happen later this year. In order for there to be a lot of deals announced in the first couple of quarters of this year, those deals would have had to be in the market at the end of last year, and they weren't. But if we're now talking about people starting to come out to market now, come out of the woodworks, let's take things out, then it does look like there could be a pretty good second half of this year as far as M&A activity. So I think that's what people are cautiously optimistic about, that the second half of this year could be really, really exciting and great. We're supposed to talk about AI in webinars. That was the rule in 2023. And I think that's the rule in 2024 too. But I do think there's a lot happening in AI, and if people are trying to decide, like, do I want to acquire something from an AI perspective, or do I want to start growing it in-house? I think we can start to see some transactions there. I've heard that from a few people. There was a lot of venture capital investment, not so much last year, but more the year before in 2022, into behavioral health, into other parts of digital health, into women's health. And some of those companies may start consolidating this year. I've heard that from a lot of people. Maybe there are opportunities outside of some of the companies we've been talking to. Maybe we need to go in to see which VC-backed companies have grown large enough to be consolidating. But I think it's interesting. Are the big disruptors, are they walking away from healthcare? No, the big disruptors are really focused on this space, right? CVS, Walgreens, United, Cigna, Amazon is in healthcare now, and they're making more and more moves. So I think that all of that is contributing to this cautious optimism, in addition to everything we've talked about already. What do you think?
Look, I think there's going to be um, uh, anecdotally, it's very interesting, and this is like from in the legal world, right? Lots of clients sign your engagement letter and about it, want to get you hired up to do a deal. And in 2023, it was happening a ton at the beginning of the year. But then the client actually asking you to put pen to paper and do something,
Yeah.
right? Never happened. I could point to 20, 30 engagement letters with clients on deals that I didn't bill a 10 minutes on. The deal just never did anything from there.
Yeah.
That dynamic is different already, just a couple weeks into January. I'm seeing again, totally anecdotally, right, that been engaged on transactions and we're working on them. And like anybody, let's hope that those deals stay on track and get done, right? But we're one of the later participants in the deal, right? In terms of, because clients just don't want to start writing the checks to their lawyers until they need to, right? And even though you might have worked on an NDA and an IOI or LOI or something early on, truthfully, clients just don't want to, and not that I blame them, they don't want to get their lawyers engaged until it really looks like something's going forward. And that dynamic seems a bit different, even just into these few weeks of the year. And again, as you can imagine, we all hope that it stays that way. So,
Yeah. And that makes sense. And that coupled with some of the accounting firms updating some of the QOV analyses they did last year, you're not going to ask your accounting firm to update the QOV unless you're getting it ready to go out to market as well. And so I think those two anecdotal things. I mean, it's anecdotal, Ari, but we're talking about, what do you hear from market deal participants? I've heard that same thing from multiple other councils, right? So, anecdotal evidence is real. And so when you're hearing accounting firms that are updating QOVs and you're hearing lawyers actually starting to charge and bill hours on transactions, I think it's starting to look like, hey, people are starting to move on some of these things. And if they start moving now, we could see some stuff at the end of the second quarter.
Yeah, and then one of the other interesting things that I think is making a difference in terms of who's going to go to market too early on or even into the second, third quarter is that I know personally a bunch of sellers that had been waiting to refi and do a few things with growth before they went right to market. But they were, for a good portion of last year, they're talking to a lender, and literally day to day, the lender was saying, well, today's rate is here, tomorrow's rate is there, and they were like, oh, kind of a,
Yeah.
I can't, I need some surety about what my rate on my new financing is going to be so that I know how I'm going to be able to use this money and then go to market. And that dynamic, as far as I understand, at least with the folks that I know have been in that scenario, it has died down, particularly because folks, the Fed has essentially said, we're not turning the dial up. So,
Yeah.
and I think even just that we're not turning the dial up, not even that we'll turn the dial down, but we're not turning it up, right, has given people the opportunity to say, okay, now I know what this is going to look like.
Yeah. And it's
that may
interesting.
make. Go ahead.
Oh, no, you go ahead.
I was gonna say that just my expectation for those few folks that I know that are in that scenario is that it's going to make life a little bit easier for them to move forward.
Yeah. Yeah, I mean, definitely not only kind of having a little bit of a clearer view of what's going to happen to interest rates, like, can I borrow this money? But also we were talking about, there being, dry powder with the PE funds. There's also a lot of strategic companies out there that didn't actually have access to capital during a large part of the last couple of years because lenders weren't lending them money. I got a call just the other day from a strategic buyer who called to say, I know we talked about this deal last year, and I didn't have, the money to be able to do it last year, but I really want to be, in the fray if you're still taking it out to market. What's interesting is we haven't actually taken that deal out to market yet. But it was really, exciting to hear that because that means that some of these, bigger buyers in that space are actually, better funded now than they were in the middle of 2023. And we did see in some sectors, across healthcare services, there were some, typical very aggressive buyers that kind of sat on the sidelines during 2023 because they didn't have the financing to be able to do those transactions.
Yeah, and we'll talk a little bit about this later too, and I don't want to jump back into 2023 too much, but one of the things that we certainly heard a lot was there were no tax change pressures, right? There was nothing squeezing sellers to make a deal last year, particularly, right? And as a result, you had a lot of sellers saying, I want my price just because that buyer can't get the money to pay that price doesn't mean I'm going to all of a sudden run a fire sale, right?
Yeah.
I can wait another year. Like, I don't need to, there's, I mean, yes, in certain circumstances, and I had this last year, folks were like, well, I got to retire. I got to get out of the business. That's a different circumstance. But even in those circumstances, you had people saying, shoot, I'm not gonna have my kids lose 20 million on a deal, in a essentially uh, what my full estate's going to be worth, because they can't afford to buy the business at the valuation it should be at, right? And that's not my problem from the seller
Yeah.
perspective,
Yeah.
and I thought that, and I think that that was a very, very interesting dynamic.
Yeah.
Um,
There
and
wasn't this external pressure, people might have had personal pressure, but there wasn't external pressure kind of
yeah,
forcing transactions when people weren't getting to the valuation that you wanted. And so you could wait. And that's what we're talking about, right? People were just waiting and seeing who blinks first because they could. They didn't have to succumb to that.
yeah, and I think that, you know, at the very least on the buy side, we're seeing more pressure, also more opening of certain pressures to allow buyers to do deals a little bit better in 2024. But I'm not so sure, right? In fact, I would say there isn't. I don't see a lot of things externally twisting the arms of sellers for
Yeah.
2024, right?
Yeah. No.
And so it'll, makes for what'll be an interesting year, hopefully, but hopefully a good year.
Well, I
So
think it comes back to at some point you can wait for so long, but at some point you're gonna, potentially want to sell your business, but you're still probably not going to take the $20 million haircut, but maybe you'll take like a couple million. And so that's where it's like there needs to be some meeting of the mind as to where can you get that in the middle.
yeah.
Um,
One of
and
the things that I've heard, and I actually wonder too, like what your perspective might be on this, which is one of the things I've heard is sell side bankers saying to folks, like, look, we really don't know, frankly, if it's going to be a banner year or not. But the fact is that if you end up being one of the 20,000 fish in the sea in second quarter, you may actually get killed on your deal. You may not get the best deal that you can get, right? So yes, I totally understand the why would I sell for less than I think I'm worth, and but at the same respect, if you end up with a flooding in the market, think about just basic supply and demand, right? You may not get the best deal you want to get because all of a sudden there's money coming from everywhere, lots of deals in the marketplace, and nobody really wants to pay you, and it's very interesting. So
yeah, that's interesting because while I do think I do think the first quarter is going to be a little bit slower. This is when people are going to start trying to take things out to market, and then into the second quarter and into the third and fourth quarter where we might see like a flood of transactions close at that point in time. What I don't necessarily think is going to change, Ari, is I don't think that people are suddenly going to become less risk averse. I think they are still going to be cautious about like taking a harder look at things, really trying to analyze and scrutinize everything. They're just going to have to then figure out how to get around some of those things so that their investors aren't breathing down their necks of like, what are you actually going to spend this money on? But I don't think that later this year is going to be like the end of 2021 where people were just trying to get stuff done quickly just to get them done. I do think it's going to still be a situation where yes, there's going to be a lot more activity, a lot more transactions, but still people being careful about the transactions that they're doing. You don't want to go from telling your LPs I haven't used your money yet to I used your money on something that's now a problem. You want to
no,
go
yeah,
from
of
I haven't used your money yet and now I'm using it on something that's really exciting. This is why we waited, right? That's the
yeah,
message you want to give. This is why we waited. But what I do think is, one of the types of transactions that have been getting done over the past year is, companies that are like those A plus companies, A minus companies that are just really like crown jewels. Those have still been getting done, right? And have been getting done at exciting valuations because people do get really excited about something that's really cool, and that they can wrap their heads around, wrap their teeth around, and just really be really um, able to take that back to their LPs and look at this great transaction that we did. So I think there's some truth to what you're saying. You don't want to be in the market when everybody's in the market, but you also want to be in the market at a time when you are ready to go to market and when your company is prepared and all of that. I, I think that if someone asked me, like a lot of last year, when people asked me, is now a good time to go to market? My answer was no, I think you should wait. And because of this, and this, I think now the answer is starting to be, here's what's going on in the market. People are going to start coming to market. If you think this is a good time for you to go out to market, let's test the waters and see what's out there.
Yeah, yeah. So let's switch gears a little bit and just talk about, what I always love to talk about, kind of segmenting what's going on in healthcare and what seems to be the flavor of the week, the flavor of the month. Essentially, what subsectors are you seeing folks start to focus on, and what subsectors are folks starting to say, no, leave that behind. I'm not doing that, and I'm not interested in
Yeah.
been done there, kind of stuff.
Yeah. I think so. I think a few years ago, people were really interested in procedural events, these individual events that could happen. People were interested in transactions that had easier reimbursement that they could understand. Now, I think from last year into this year, and I think it's going to be more this year, people are really focused on repeatable events. We talked about primary care, but cardiology. We were talking about cardiology all of last year, but there have been, a few big platforms that have been announced, and there's, we have it on one page, all of the cardiology companies that are out there, right? But those companies going out there and doing more and growing, I think we're going to start seeing more of that, because that is a repeatable event. It's that all of the population demographics point towards that. Med spa, we're hearing about a lot, and med spa, slightly different from reconstructive plastic surgery and derm, because med spa is healthcare, but with a consumer focus and something that can be grown quickly. And so there are a lot of investors that are really interested in that and are, chomping at the bit to get additional med spa companies under their belts and then grow them. Infusion is something that we're hearing more and more over the last few weeks that we weren't really talking about last year. So that's something that wasn't from 2023 to 2024, but rather something that's a little bit newer that people are excited about. I think it goes back to the repeatable events. And then surgery centers. That I think is a long-term push from COVID, where people didn't want to go to the hospital anymore. They wanted to be in outpatient centers. And there's also some regulatory changes in some states that are allowing more surgery centers. You know a lot more about that than me, so I'm not going to get into that. But I think we hear it over and over, if people have surgery centers, we're really interested in talking to them about that. So I think that when we're talking about the traditional physician type of transaction, I think those are the things that people are interested in there. But I think also we've been talking a lot about staffing as a challenge. So if there's a model where good healthcare can be provided with less staff, or maybe less bricks and mortar, a hybrid with digital or tech enabled or home-based care. And I don't mean, the traditional home health, but, outside of that traditional home health, home-based care, because then there's less brick and mortar, less staff that's needed for a lot of those types of businesses. So I think that is going to be really interesting. I hear about that a lot. And maybe this is because I do behavioral health and people know that, but I still hear so much chatter and excitement around behavioral health. And I think that's across the different subsectors within behavioral health, whether it's mental health therapy, substance abuse, eating disorders, TMS, ketamine, things like that, but also people that are creating these hybrid companies across several of those subsectors, meeting the patient where the patient is, so that they can capture a lot of that business. Women's health, I hear about a lot. I think PE investors really want to be in women's health. I think there's a lot of companies, I think this is true for behavioral health too, but there's been a lot of venture capital activity in this space. But some of those companies may be starting to get big enough. Maybe they're starting to get big enough where they can consolidate this year, and that would be really exciting to see some of that happen. But I think to the second half of your question, like what's on the cutting room floor, there have been so many different challenges in healthcare that when you talk to one PE firm about what is not interesting to them versus another PE firm about what is not interesting to them, it's like two different PE firms. One will say, I'm really excited about this. One will say, I'm not touching this with a 10-foot pole, right? I in the last 2 days, I had two different conversations where one PE firm said ortho is what I want to do all day long, and another one said I don't want anything to do with ortho. So that's a big difference from one to the other. Some of the things that I do think are harder for people are the sectors that are already consolidated up so much, dental and eye care, stuff like that. Where if you were going to jump into that fray, you have to buy such a giant company, or you have to be willing to consolidate all of these tiny onesie twosies. So I think those are the types of sectors that are harder. Home health, I've seen a lot of challenges with over the last couple of years, and certainly, going into the beginning of this year, because it's so fragmented. I think there's a lot of people that want to consolidate up some of the smaller players, and then I think people might be a little bit more interested in that. But I really think there's so much going on in healthcare, so much innovation, and we're trying to solve some of these healthcare challenges. And there could be some really interesting transactions that happen, putting together different things that are not, you wouldn't traditionally think of, like that these things can go together to try and create some of those hybrid models. And I'm really interested to see that, because I have been having a lot of conversations about things like that.
It's
What do you think?
interesting.
What are you hearing?
Well, I'm going to broaden kind of a little bit of what you started out with, which is I have seen a lot of folks, even, by the way, even on the venture startup side, focusing on, and I'll take the distinction that you made between boom, boom, boom procedures, right, as opposed to ongoing services, right? And the focusing on chronic conditions. By the way, I throw mental health in with that, okay?
Yeah.
Behavioral health in with that, where there's at least an intent on a stickiness to a patient with ongoing need for services and supports, right? And so there are really interesting, even startups
Mhm.
using technology and bricks and mortar to go after chronic disease states. There's
Yeah.
folks focused on gastrointestinal disorders. There's folks focused on endocrine disorders. Folks focused on nephrology, that are
Diabetes.
diabetes.
Yeah.
And frankly, when you think about what you just said about somebody coming in and putting all that together, the when you think about the backbone, the skeleton of how they're doing those things,
Mhm.
it's not incredibly different by chronic disease state. Do you know what I'm saying? Having
Yeah.
a telemedicine piece, having a associated specialty pharmacy, having a bricks and mortar potentially, outpatient office for patients to be seen. Um, you know, you can do that in diabetes care, or you can do that in gastro, right? And that skeleton of what you need, the back office, essentially, the backbone to it all is the same. And so you could potentially pull together um, uh, a larger platform, right, that's working on a bunch of different chronic disease states, but the back piece of what you're doing is the same anyway.
Yeah. Yeah. I think that's really
Patient
exciting.
engagement,
It's yeah.
patient engagement across those things, same kind of a thing.
Yeah.
You
Yeah.
don't need five different iPhone apps in terms of what the technology used, right?
Mhm. Yeah. And that shift that you were just talking about, where we move from being patients to being consumers of healthcare, that shift has been happening over the last 20 years, right? And the easier you can make it for a patient who is now your consumer and your customer, that makes it a lot easier for them to actually engage. And then you can provide better healthcare, because maybe they will then, medical adherence, for example. If your app is easier for them to use, and it's easier for them to call in, and maybe it'll be easier for them to, take the medication. So there's a lot of these things that have all been driving over the last 20 years or so. I say 20 years because that's how long I've been in healthcare. So I don't know what happened before that, but and it's really exciting. It feels like it's snowballing, because, as you said, a lot of these things are very similar models, and they can be done in different disease states and maybe put together so that, the patient only has to go to one place.
Some of these, but particularly in diabetes care and in gastro, and you've got added on to some of these startups, as well as sort of somewhat really thought out models, wellness, nutrition, and other things that folks are getting on a subscription model or otherwise, that are healthcare light, right?
Mhm.
But that are creating a ecosystem for the patient,
Mhm.
right? That the patients are really interested in, right?
Yeah.
And so some of that stuff has really, I think, become very interesting. I think I've seen a lot of money go towards it,
Mhm.
and we'll see how it continues to play out. And it is not your parents' disease management, put it that way,
Yeah.
right?
Yeah.
It's very different what we're doing now than what we did 20 years ago, even.
Yeah.
It's just very, very different.
Yeah.
Okay, let's talk a little bit about um, uh, the kind of what I call sort of the Plato stretch, or the stretchy whatever of deals lately, and how
Yep.
it just, and in fact this was happening before 2023 also, just the what seems to be the lengthening of when people start talking about a deal, maybe even enter into an LOI, and when we're actually getting to close. You alluded to it before, and we said we're going to talk about it, and now we're going to talk about it, which is, even have scenarios that I've seen a lot, particularly in 2023, but
Mhm.
where the length of time just seems to kill the deal, right? You get deal
Mhm.
fatigue, and folks, either buyer or seller, just say, yeah, this is enough already. We're not going to do this one.
Yeah.
And so thoughts about that?
It's tough, Ari, because you have to strike the right balance. We've been talking about how buyers have become more careful about risk. They're a little bit skittish, and so you also don't want to push them too fast, right? Because then they'll say, "Okay, what's wrong here? Should I be walking away? Why are they trying to push me along so quickly?" So there's this delicate balance where you do need to keep the deal process moving forward. I think getting really organized before you even start the deal process is really important, because then when people are asking for information, you can be quick to get it to them, as opposed to then having to go get it from the client, things like that. Because every single like negotiation book tells you like time is a deal killer, right? You need to push things forward. But you can't push things forward too quickly, because then people get anxious. What am I missing? I do think that there is some level of people, over analyzing transactions in 2023 and 2022. I think that's when this started, in 2022. Over analyzing things, and as a result, just taking so long that everyone got uninterested in the transaction. Now we're, a lot of the dynamics we've been talking about, where LPs are breathing down people's necks, like, what are you going to do with my money? I think that'll make people move a little bit quicker and move a little bit faster, and kind of try to drive towards, am I doing this transaction or not, a little bit more quickly. And if they are, what do they need to get the transaction done so that we can get to a closing, right? But I do think being really prepared before you start, which a lot of people are going to be, because a lot of people have been spending all fall getting prepared to go out to market. But really being really prepared before you start, and striking that balance between getting the information to people quickly and pushing them along, but not pushing them so fast that they get skittish. I think that's going to be really important, with 2024, because let's just be frank. Like, nobody wants to repeat 2023 and 2024, right? We all want to do a lot of transactions. Money and ideas and innovation. This is what drives healthcare forward. We're all in healthcare for a reason, because we find it interesting. So we all want to do these transactions because it pushes all these companies forward, gives them more resources to be able to provide better healthcare, in the right scenarios. And so, we can't continue to sit in this situation where these deals just keep dying for no good reason. People need to actually get to the point, like, am I doing this transaction? And if not, let's release them and have them go do it with somebody else.
Yeah, I have one interesting thing that's happened a bunch, and I hope it stops, which is like I've had folks negotiating LOIs for months,
Oh,
and
yeah.
I'm like, what are we doing, folks? Like, not that it's not important to get major terms in front of
Mhm.
everybody to
Mhm.
really decide to move forward. It's very important to do that, but you're either one side or the other is essentially trying to negotiate the entire deal via LOI, and that's kind of silly, right?
Yeah.
Um, and or uh, uh, you almost feel like sometimes, and I've seen this both buyer and seller, where I've said, like you just threw a deal killer into the LOI. Like, why? Like, what? If you don't want to do a deal, don't do a deal. Like, why would
Yeah.
you? put that in front of everybody right now. Like, and it's very, very interesting because I've also had conversations with folks where I've said, that's later on down the road, folks. Can we get this signed? Like,
Yeah.
agree that you want to move forward with these folks, and then we can talk about all that stuff later. Like, there's
Yeah.
no need to, there's no need to get some of those points into the LOI, and I hope that dynamic changes as we go into
Mhm.
2024, that people start to become smart again about what an LOI means and what it does for you.
Yeah.
I mean,
I think you need the key deal points in the LOI, and not things that you like. Don't start negotiating some of these like more minute deal points in the LOI, because then you might agree to something either side that you actually want to change when you get through due diligence. And that creates another problem because now both sides feel like you're trying to change something from the LOI to the definitive agreements. And so if you're in a position where you can agree to the key deal points, put those in an LOI and start moving forward to figure out if this deal makes sense.
my favorite in an LOI is um, uh, a buyer telling a seller that's a professional entity that they're going to buy 100% of the equity of them. And I always say to my client immediately, if I'm on the sell side, would say, well, they can't do that. They don't know what they're doing. And it becomes this whole conversation. And I'm like, that is the last thing that matters. What matters is that they're telling you they want to pay you 60 million for your business. At some point we'll have the structuring conversation. We'll get it all right. You'll get your 60 million, okay? But like, to sit here for 3 weeks trying to put in the LOI what the right structure should be, because they in fact don't even realize that you're a professional corporation, right? Like,
Yeah.
they don't. I mean, at that point they're not even, they haven't even gotten past that, right?
Yeah.
We're just going around in circles over a point that for the deal to get done has to be fixed anyway, and everybody knows that, right?
Yeah.
And so,
This is a corporate practice of medicine problem, so it will not be
yeah.
happening this way.
Okay, let's move on to our last point and then open it up for a little bit for questions. And it comes to some extent about off of a lot of the stuff that we've been talking about, which is, you know, paying the entirety of purchase price at closing right now is the exception rather than the norm. I mean, it really is the exception rather than the norm. Why are we seeing so many folks saying, and by the way, I'm going to say this, and I didn't tell you this yesterday, but the other day, but I literally had an LOI put in front of a client a few months ago where top purchase price was 105 million. And when you read through all the deferrals, they were getting 15 million at closing.
Wow.
And I said this to the client,
15%. Wow.
I walked them through it. And
Yeah.
I was like, I don't really understand like why they would have even put this in front of you. It is like it's anyway, but you know where I'm going with that, which is just kind of what's going on with the fact that while we may decide, hey, we're going to pay X for this business, you're not getting X at close, right? This is how we're going to structure it.
And there's probably a lot of caveats to how you get the other part of XYZ. I think it's, what we've been talking about here, which is, the sharing of risk, right? There's challenges going on in the market. Are you ever actually going to get those patients that you said you're going to get, or do you need to, hire a whole bunch of people that don't exist to be able to get them? Are there risks associated with this business? Meanwhile, the seller is saying like, hey, I've built this business over 15 years. I think it's really great and I need to get the value for it. And so how do you bring those two things together? And I think that's, that's one of the ways people are trying to get around that and try to bridge that gap between seller and buyer and bridge those expectations. Like when I see those types of things, it's like neither side wants to take on the risk of this transaction. Right. And the sellers, they're the ones that have built the business. Like once they do this transaction, it's done. So they don't want to take on that risk. They want to get the value for their business. And like we said earlier, some people are just going to wait for another year or two until they can get the value for their business. And the buyers that are saying like, okay, like, yeah, I can meet them where they are, but I'm going to need to create this other structure to be able to get it to them, which I'm probably not going to end up paying them because I've created so much drama. I mean, if you're talking about 15 to 105, like what are the chances it actually gets to 105, right? And so
Some of the
that's just a huge
triggers were
bridge.
ridiculous,
Yeah.
so.
But I think it's, that I'm being a little pessimistic about it, but I think, in actuality, it's people trying to be creative to get transactions done in a space where there is this gap and you need to bridge that gap. And, how do you bridge that gap? And it's a bridge. It's a gap that needs to be bridged on valuation and a gap that needs to be bridged on risk as well. Who's taking on the risk of whether this business is going to do well next year. So I'm not talking about, regulatory compliance risk, all of that stuff, but really the risk of who's going to take on the risk of how this business will fare going forward. Are you actually going to be able to continue the growth trajectory that we've seen? Are you going to get that pent up demand? Things like that. And I think it's encouraging that people are being creative. But I think people need to be a little bit more creative while also putting their money where their mouth is. And kind of, like the example that you gave is kind of funny, but also, frustrating from a seller's side, because you want to get the value for the business that you've built. But from the buyer's side, it's like, okay, like there's some risk that you're going to have to take on with this business because you are the one buying it. And a lot of whether this company can actually do what it says it's going to do is going to be in your hands. So can you make it happen? And I think we're going to see more creative structuring in 2024, but hopefully less of this giant gap that has to be bridged. And so maybe we can come together in the middle and figure something out. But I definitely think it's encouraging that people are being creative, because that points to they want to do transactions.
Yeah. Let's see if we've got any folks that have questions for us. If not, we can, I think there's a little bit more that we could probably talk about this particular issue. So if you've got a question, throw it in the chat. We're happy to take a little bit of the last few minutes of the webinar to address any questions. Let's see what we get. If we get anything, it's not surprising to me that we never get anything.
We've only left them 2 minutes, Ari.
Even so, there's still time for asking questions. If you want to ask a question, ask it. So.
Ari and I are both chatty, so every time we get on the phone, we chat for an hour.
Yes. We kind of have to cut each other off.
Yeah.
But anyway, with barring no other questions, one thing that we about this particular issue is, and you saw it a lot last year and even before that, that disconnect between purchase price expectation was a lot about how expensive money was, right, for a buyer.
Yeah.
And so you did see, and you still see, buyers essentially agreeing to take risk by saying to a seller, look, and not necessarily outright saying I can't afford to pay you that much, but they're basically saying I'll pay you X at closing, and then they're taking risk that there'll be growth in the company, right, over 12 months, 24 months, whatever it is, to then be able to circle back to the buyer and pay them the extra 10, 20% or whatever they didn't give to them at closing.
Yeah.
For the most part, the folks I know that have done that have not come back to me and said, "Uh-oh, we're screwed. We can't do it." But I've not heard anyone come back and say, "I'm in trouble. I can't meet my earnout that I agreed to," or whatever. But I've seen a lot of that where it's just like, it's not that I don't want to give the seller 40 million. I can't. I can't get 40 million to do that deal. I need the seller to understand that we'll give them 30 and the other 10 will come. And I think that's been a very interesting dynamic that I suspect is going to continue. I don't see that even if the markets open up. I don't see that changing.
There's a growing divide between the buyers that are out there that have capital versus the buyers that are out there that have to go get capital for transactions. And if you have capital, you can take advantage of a lot of opportunities in the market, because the people that don't have it need to go get it, and it's hard to go get it.
Yeah, definitely.
Yeah.
Well, Vasanta, thank you so much. This has been a wonderful conversation, as always. I appreciate you taking the time. Thank you everybody for joining us today. And here's to having a really great 2024.
Yeah, thank you for having me, Ari, and thank you to the Venable team, and thanks for everyone for joining. And I am going to second what you said, which is let's have a great 2024.
Take care.
Bye.